Well, first of all, I would like to thank the organizer, Lama and Fida. You're doing amazingly well. You organized amazing conference with a good line of presenters that make all of us proud. We know, like all of us, like women representation in many disciplines is really low, and as women in the Middle East as well, we should help women appearance in different discipline and involvement, and this is one of the great initiatives. The previous panel put a very good stepstone for this session. We are moving from sciences towards human education and human research. So today I'm going to speak to you a little bit different than what we started with. It doesn't mean it's completely different. We are using similar tools and similar techniques, but we are starting the starting point a little bit different. Let me show you how I am different than the previous presenters, amazing presenters. So my field, as mentioned, is based on banking, financial intermediaries, and regulators. Before I start my own research, let me show you a holistic view of our discipline, or my discipline in particular. So we are looking at big data and financial intermediaries, big data collected from different fields in the financial intermediaries. For example, we have data from regulation and compliances for financial intermediaries. We have many million of data for customer data. Transaction data can come from retail and wholesale. And we have data from risk management. And as you may know, financial intermediaries include many types of financial intermediaries. We have asset management. Asset management, we have it to private, like hedge funds, and we have, for example, a mutual fund, and we have pension fund who basically manage our retirement. We have banking, commercial and retail, capital markets, and insurance. Big data are being continuously collected through different transactions. Those transactions can be related to pricing, operational data, and for example, operational data can be from order activities. So today, I'm going to talk about the small red area. I'm going to try to conduct all of those areas to show you how I use big data in my own research. We have a problem in finance. The problem in finance, the data collected intensively in different parts of financial intermediaries, but this data not connected. Similar problem that Lubna mentioned in her field, zero data. We have some data, but unfortunately the data not connected together, or because of a privacy issue, this data is not available for everyone. As a researcher, this is a challenge for us because we want to address and solve problem in the financial industry, but at the same time, we don't have data to actually solve those questions. And this is how we are innovative in my research with my group. I have a team of researchers that work with me, PhD students and colleagues, to uncover or answer those questions. And if you know, I think most of you, and unfortunately, the financial industry is not very popular these days, especially after the financial crisis. Unfortunately, ethics is not working very well. Illegal activity is very common. Market manipulation happening very frequently, and it's a big nightmare for regulators. And my research actually linked to those issues. For example, we have, after the financial crisis, there was market manipulation with LIBOR. LIBOR is the kind of interest rate for borrowing and lending at a higher level, at a wholesale level. And also there is some problem with the foreign exchange. There is some market manipulation in those two sectors where actually it's done and used on a daily basis among large players like banks and other financial institutions. Regulatory bodies try to collect data and encourage for data collection to increase the transparency in this sector. So following the lead of those researchers, we are trying to address in our research with my group, market manipulation. So the data, as I said, not available, and our innovation is to answer important questions, by connecting a source of data from here and there and try to find out or resolve some stories. So my work with my PhD students and colleagues motivated by this Business Week article. This Business Week article basically addressed an issue for one of the companies. This is Movie Gallery. It's a big company with the videos. Borrowed fund from financial intermediaries. This financial intermediaries, usually you borrow fund from a bank. You need to buy a car as an individual. You go to the bank and fund your car. For a firm with billions of dollars of need of fund, they cannot borrow this millions of funds from just one bank. Sometimes they borrow it as a syndicate. We call it syndicate loan, where a group of lenders get together and lend this company the amount of fund they need to fund their projects. Unfortunately for this company, the group of syndicates, they were not banks, they were mostly hedge funds. Hedge funds, they are aggressive in the market, they want to make money, and their objective also to achieve target of making return higher than what the market is making. So they have to be innovative in their investment strategies. So those hedge funds, so in other words, their objective function little bit different than a bank. A bank, they want to maximize the profit, but over a long term. For a hedge fund, sure, they want to maximize the profit, but they want to hit and run. They are short-term profit maximizers. In other words, they're willing to do anything to achieve their targets. So after they borrowed from those group of hedge funds, Movie Gallery, they have problems. They have financial problems. The financial problems not revealed to the market directly. It was discussed among the management team, and they called the borrowers to help them to reorganize the loan. So after the hedge fund called to reorganize the loan, they accepted. This was done in March 6. After that, the lender accepted to amend the loan, and they changed the term of the loan by increasing the interest rate and by increasing also the amount of loan. After then this is when the announcement went to the market. Now everybody knows this information about Movie Gallery. Let me show you what happened to the Movie Gallery shares. This is the short selling. Are you familiar with the short selling concept? You are. So short selling, basically, when you sell something you don't own. You borrow it from your neighbors and you sell it. And the objective is to sell it to somebody really low, and in the future, to sell it really high and buy it really low. And you make the profit between the difference in the prices, okay? So this is the short selling activities for Movie Gallery prior to this announcement. So the price, for example, when they called the hedge fund was 3.27. And this is when it went to the public announcement, the price dropped to 2.28. So you made almost $1 over 11 days. Okay? So this is potentially what you could make. And if you look at the short selling activity, just after the announcement, just after the meeting for renegotiating the loan, look at the spike in the short selling. So basically, the short selling was really low, and suddenly the short selling increased. And what happened? When the information revealed to the market, the share price dropped. In other words, if you short sold within this period, you could make lots of profit. Now the question is, does this behavior, is it related to all loans or average loans that lend by hedge funds? We consider this action as market manipulation, because you are actually trading on a private information before it's revealed to the market. So we want to investigate whether this kind of activities happen very frequently in the market. And this is what we done in our research. So what we did, we collected data on short selling. We have the data for short selling, but we don't have the identity of the short seller. So in other words, we want to back out the behavior from the data itself. So what we did, we combined this large database, which I showed you before. This is the kind of data produced by financial intermediary. We combined it by 6 other databases. So we need also database about loans, syndicate loans. So we have to look also when those loans actually get renegotiated. We have to do textual analysis. And also we need to understand in which loan the hedge funds are involved in. So we have to match the name of the hedge fund with the loan item and the name of the firm as well. So we have a firm and many lenders. We have borrowers and lenders, and we have to match all of those databases together. And the short selling data will be matched at the firm level. So in total, we have this large database, and in that way, we will be able to see the behavior, whether if the loan extended by hedge fund will be different than the loan extended by banks. So what we did, so we formed 2 groups. We group of loans that initiated by hedge fund and a group of loans that initiated only by banks. So the treated sample is the hedge fund, and the match sample will be the bank. And look at the short selling activities around the loan, actually, just prior to the loan renegotiation or the loan initiation, and look if there is different pattern of behavior in short selling activities. As I said, short selling activity, if there is a spike prior to the announcement of loan negotiation or initiation, this is indication of market manipulation. And sure enough, we found a very big difference in pattern between hedge fund and banks. So this is one aspect of it, where we have the treatment and the matching sample. And then we looked at the severity. If the amendment in the loan, similar to movie gallery, was penalizing, it became more expensive, or it's more favorable, whether we see difference in the short selling. And actually, yes, we see difference in the short selling. The short selling is more severe. In other words, market manipulation is more severe when the amendment is basically not favorable for the firm. While when we compare for the banks, it's not the same. So this is basically how we use big data in helping our understanding in market manipulation. So in conclusion, what we found hedge fund using this big data more likely to make loans to risky borrowers because they are more short-term profit maximizers. And we showed proof that hedge funds are more likely, not every hedge funds, but on average, hedge funds are more likely to use this data as a source of creating more profit and taking advantage of the borrower. In other words, what we noticed is that the short selling is more likely to happen when hedge funds are involved in the loan. This raises very important regulatory issues with hedge fund involvement in the loan industry. It was previously dedicated to the banks, not to hedge fund. In other words, long-term profit maximizer over short-term opportunistic profit making. Thank you very much.